What happens with a non-qualified 529 plan, withdrawal for General X? Have you ever wondered what happens if you take money out of a 529 plan for something other than education? For Generation X, this question is especially important as they juggle saving for their children's education and their own retirement. A non-qualified withdrawal from a 529 plan can have some financial consequences that you should know about. When you make a withdrawal that is not used for qualified education expenses, it is considered a non-qualified withdrawal. This means that the earnings part of your withdrawal will be subject to federal income tax. On top of that, there is typically a 10% federal penalty tax on those earnings. The good news is that the money you originally contributed is made with after-tax dollars, so you will not be taxed again on that amount when you withdraw it. Qualified education expenses include tuition, fees, books, supplies, and equipment required for enrollment. Room and board can also be included if the student is enrolled at least half-time. Recently, the rules have expanded to allow up to $10,000 per year for tuition at elementary or secondary schools. Costs related to computer technology and internet access for the beneficiary during enrollment are also considered qualified expenses. For Generation X parents, who often face many financial responsibilities, making a non-qualified withdrawal can disrupt their financial plans. The additional taxes and penalties can reduce the amount of money available for other needs. This could mean reallocating resources or increasing savings in other areas, which can be quite challenging. However, there are ways to lessen the impact of non-qualified withdrawals. If the beneficiary decides not to attend college, you may be able to transfer the funds to another eligible family member without incurring a penalty. Additionally, recent legislation allows for 529 plan funds to be rolled over into a Roth individual retirement account for the beneficiary under certain conditions. This option provides more flexibility for future use of the funds. To avoid non-qualified withdrawals, Generation X individuals should carefully track their 529 plan withdrawals. Keeping accurate records of qualified expenses is essential. It may also be wise to consider alternative education paths, such as apprenticeships or trade schools, which could qualify for 529 plan funds. Balancing college savings with retirement contributions is vital, as retirement funds cannot be borrowed against, while education costs might be covered by loans if needed. In summary, a non-qualified withdrawal from a 529 plan results in income tax and a penalty on earnings, which can diminish the tax benefits of the plan. For Generation X, careful planning is key to maintaining both education funding and long-term financial health.